and welcome to this episode of Nucleus Wealth Empower, where I go looking for the good life, what it is, and how finance can support and empower us in achieving that. Before we start today, I'd like to start in the spirit of reconciliation by acknowledging the traditional custodians of country throughout Australia and their connections to the land, sea, and community. I pay my respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islanders peoples today. So today we're recording this in a nervously pre-lockdown Melbourne, where the Nucleus Wealth Head of Investments, Damien Klassen, is going to join me online to talk about the financial market topic of the day, inflation. Damien, welcome and thanks for joining me today.
Thanks, Shelley.
So a quick reminder before we get started, if you haven't already, subscribe and click the notification bell to be notified when we go live, or have a new webinar to watch, or follow us on your preferred podcast platform. And we also ask if you could take a moment to click the like on the video now to help our show grow. Alrighty, so let's get started. Inflation. Obviously, it's very topical at the moment. So I'd almost say it's the topic of financial markets. But let's start really simple. What is inflation?
Yeah, so there's sort of a couple of different elements of inflation and how it's been treated in the past and talked about. Initially it was talked mainly about the supply of money, but it's generally in recent years it's been sort of devolved into talking about what is either consumer price inflation, so how much inflation gets brought back to ordinary people. So what your healthcare costs go up at, what your grocery bills go up at each year. So that's one type of inflation. There's another type of inflation called producer price inflation, and that's more talking about the cost of inputs into different goods and services. And then finally, there's something which people talk about called the GDP deflator, and that's actually talks about that's outside the scope of this, but that's a more complicated one, which looks at both at countries' exports as well as imports. Countries' exports as well as all their production to try and work out, how much of a country's growth in wealth over a particular period was because of prices moving and how much of it was real and genuine growth. And the one that matters for most people is the consumer price inflation, because that's the inflation which you face on a day-to-day basis, and that's the one which the Reserve Bank or the central banks, when they're setting interest rates, that's the one they look at. They look at the inflation that is for consumers.
Okay, so you've touched on that CPI is the one that day-to-day people should be worried about or looking at. So why is inflation important for everyone?
Yeah, so because this is what's going to determine whether your costs are rising faster than your wages, for example. So if you've got wage growth of 5% per annum, that might sound great, but if inflation's running at 6 or 7%, then that actually means your costs are rising. Your general costs of buying food, clothes, those types of things is all falling behind. And so, so for everyone, it's very much a matter of trying to work out that inflation versus your earnings power, and whether your investments are actually beating in that inflation. So that
so because what you want is essentially if your wages go up, you want to be able to buy more goods and services, right? So you want that wage to be growing more than inflation, so you can therefore buy a greater basket as opposed to a smaller basket if it's the other way around.
Yeah, exactly. And that's when you say a basket, that's exactly how they put it together in terms of saying they look at saying, well, if somebody bought a couple of bananas and a couple of apples and some meat and some veg and some pasta and stuff like that, then here's how much that would cost if you bundled it all up. And if you looked at people buying, say, a new laptop once every 2 years and a new car once every 5 years, or whatever it is, that they'll put that all together and then say, there's your basket. And one of the things that actually shows up as well is that that I like to highlight, especially over recent years, is that there's been more inflation in some of the items which are the must-haves, and there's been less inflation in some of the like-to-haves. And so, an extreme example of that is that vegetable prices have been going up faster than the price of ice cream. So you need your vegetables. You have to buy them. Your ice creams are like, well, I don't have to buy it, but that's had deflation. Well,
Lockdown number whatever in Melbourne. I'm saying ice cream and alcohol is need to have.
yeah, but the other thing is you notice is that things like washing machines, computers, uh, electronics, TVs, all those types of things, and have had a fair bit of deflation in them, and a lot of that's sort of come from Chinese manufacturing. And one of the issues with that is for ordinary people is they're the types of things you can usually delay. Yes, I'd like to have a new TV, but you know what? Things are a bit tight at the moment. I can wait 6 months. Whereas your healthcare costs or your rental costs or your cost of food, that's where we've actually been seeing a bit of inflation in recent years. Probably not food as much, but
Mm.
healthcare and housing um, and education in particular. They're the ones which you can't say, well, I won't pay the kids' school fees this year. I'll just I'll just wait. I'll hold that off. They're the ones which you do have to meet that inflation. And so that's probably why for a lot of people, inflation often feels higher than the official numbers. Yeah.
Yeah, right. Okay. Okay, so sometimes I hear around the traps, inflation's bad. Is sort of like this mentality that I suppose the media, you hear from them sometimes. Is inflation bad?
As with everything, moderation is important. So it's too much of it's bad, too little of it is bad as well. So it's really about working out where that level of moderation is. So the bad scenarios are what is often called hyperinflation, and that's where you might have seen stuff about, say, Germany, sort of pre the Second World War, where it was cheaper to wallpaper your room with dollar bills and what it was to actually use that to buy wallpaper. It's those types of ones, or Zimbabwe, where you get these hundreds and thousands of percent inflation, where effectively the government's what they're doing is creating new money, but and then giving it to people, and so you've got this huge amount of extra money, but no extra services. And so everyone's competing to try and get the same services, and you end up with the inflation going at huge rates. So that's the bad side of it. Usually, inflation of sort of 5% plus would be thought of as bad inflation.
Mhm.
Most central banks the Australian central bank targets between 2 and 3%. Most other central banks target around 2% or below. So Australian inflation is actually targeted a little bit higher than elsewhere. The problem, though, at the other end is when you get deflation. So deflation, in a sense, is a good thing, and it's a bit of a natural state in that technology makes things cheaper, and it gradually means that things are going down in cost, which means that governments need to sort of create a bit more extra money supply in order to keep inflation a bit higher. So the
Do
problem
you
with
want to actually just talk us through the money supply and inflation relationship?
Yep. Yeah, sure. So actually, let me just deal with
Okay,
deflation
yeah,
quickly
sure.
first,
No
and then
worries.
we'll jump onto that. So deflation is where prices are going down, which sounds like a good thing. But what tends to happen when you get too much deflation, and particularly entrenched deflation, is that all of a sudden people who have debt actually find that they're actually starting to go backwards. So they bought a house for a particular price, or they bought a car for a particular price, and the deflation sending it back faster than what they're getting. Um, and so so that they're actually running into problems. The other thing you have is that people start to delay expenses. So
Mm.
if you know things are going down in price every few months, people will then say, "Oh, well, I'll wait a few months," and what that tends to then it decreases the amount of economic activity because everyone's just sort of holding off, waiting for lower prices, and that just keeps causing lower and lower prices. Um,
It's like a
and
vicious cycle downwards, isn't it, when that happens?
yeah, yeah, that's right. And the other thing which I like to think of is a bit of inflation to me is a bit like sort of lubricating your engine. There's a bit of oil to keep all the parts moving. Because what tends to happen in economies is wages tend to be very sticky. People hate having lower wages, and so if you've got a little bit of inflation, what that means is that companies that aren't going well can sort of hold wages steady. And so in a real sense, people's wages are going backwards in those companies, but in a nominal sense, you're not actually getting pay cuts every year. And in companies that are growing strongly, though, they can be raising their wages at higher than inflation, or much greater than inflation, and gradually, hiring people from the companies that have steady wages and moving them on. And it's um, that sort of lubrication and helps sort of the operation of an economy, makes transition a lot easier. Whereas in an economy with deflation, that first company is actually out there cutting people's wages and saying, sorry, you're working for those companies, Chile, and you're turning up to work and they're saying, sorry, it's a 3% wage cut this year, and next year it's a 5% wage cut. That obviously hurts a lot more than just saying, oh, sorry, we can't afford a wage rise this year for you.
Hmm.
And so, yeah, okay, so that's the deflation. The question you had was, the money supply.
Yep.
Yeah, so this is a question about what causes inflation, and the net effect is more supply than demand. Sorry, more demand than supply is what causes prices to go up. So there's people out there have $100, they want to buy things, and there's $100 worth of goods. Therefore, everyone buys it and pays for it. But now, when there's $110 and people want to spend all that money, and there's only $100 worth of goods, they'll push the prices up until the level where um, the prices are actually they'll push prices up by $10 so that everyone's trying to bidding and working out what they want to get for themselves. It's a bit like an auction in a way.
Okay.
Um, Now, if governments try and put too much money, so they actually create new money and put too much money into the economy, then everyone starts chasing. It's the same as if tomorrow everyone doubled their wealth. So just
Mhm.
overnight, government said, okay, everyone's whatever money you've got in your bank account, whatever money, all of a sudden everything's worth double.
Yep.
Pretty soon prices would double as well because everyone still wants to go out and buy the education and
Yeah.
buy the new car and buy all these things, and you just get the competition for those items until the prices of those items go up to the level
And
where everyone's
obviously, if it happens overnight, the supply of all of those goods and services, that's set.
doesn't
You're not going to
change.
change that fast enough to catch up with it. So it shows that point of inflation. Okay.
Yes.
So um, we haven't seen much inflation around the world for quite a while now, right?
No, no.
What?
So
Well,
in
why
the
aren't the governments printing money?
yeah, so in the and look, everyone's got their different take on it, and governments have been trying for the last 10 years to get inflation and failing. Japan's been 30 years where they've been trying to get inflation and failing. So it's not that. Um,
Have Japan been printing money?
yes, they're actually
Wow. Okay.
buying, not only printing money, they're out buying equities. Like
Yeah.
so
Okay.
in Australia, central banks have been out there helping to fund mortgages and helping to fund banks and things like that. In
So what does
Japan,
buying equities do?
pushes up the stock market. So basically,
Which
they're
puts
trying to.
more money in the economy to then cycle its way through,
Well,
theoretically.
that's their hope. Yes.
It's not what's
So
happened in Japan. Okay.
no, no. So Japan. I'll take a step back. I think the big part of inflation is if we go back through a long time through history. So you look back in the 16, 1700s, and earlier than that, inflation was very much tied to population growth and weather patterns. So you had a good year in crops, and because everything was pretty local, you'd get inflation because there's all this money coming in, and then you'd have bad years, and that would really drive inflation on the upside and downside. We're no longer an agricultural based economy now. Then we added a lot more manufacturing, and in the 1970s, it used to be that the money supply was pegged to the gold, the amount of gold, and then in the 1970s it came off that peg.
So what does that peg mean? If they dig more gold out of the ground, they get to print more bills?
What would happen is the US dollar used to be exchangeable for a fixed amount of gold.
Okay.
So basically you'd have to keep digging up more and more gold in order to
Yep.
be able to expand your money supply, and
Yep.
which was good in the way that it restricted governments from just printing money willy nilly. It was bad in the way that it meant that um, you're trying to run your economy based on something completely extraneous to
Mm,
to your economy, and so if you had more people or fewer people, you couldn't expand or contract your money supply, or if you had economic booms or
mm,
recessions, you,
mm.
you couldn't you couldn't play around with it. So the problem, in my view, was that what happened then was um, in the early stages of this new environment, we also had the oil price went up by over 10 times in price, and so you had
While it
governments.
was still pegged?
No, after it was pegged.
All right. Sorry. Yep. In the new
And
environment.
so
Yep.
in this new environment, so what you had was governments sort of launching this new part where all of a sudden they don't have this peg to gold and they can get out and spend money, and at the same time the oil price rocketing. And so that sort of, to me, entrenched inflation and got inflation at a high level where governments were basically printing too much money. And it got this whole mindset of inflationary expectations where people were expecting 5% or 6% inflation. And so every year they needed a wage rise of 7 or 8%. And unions, that were quite heavily unionized at the time. And so unions would demand, 7, 8, 9,
Hmm.
10% wage rises every year. Because those wage rises came through, then companies had to put up their prices, which meant there was inflation, which meant the next year you had to go back and ask for a wage rise again. And so you got caught in this sort of inflationary expectations. And the US central bank effectively put an end to that by raising interest rates high enough that it threw their economy into recession, and most other central banks sort of followed suit. And the reason and the idea behind that was that if you showed that you could crush, you're prepared to send your economy into recession to get inflation, that brought people's expectations of inflation down. And at the same time, we then went about and we put in all these other rules, and we made our central banks independent so that the politicians couldn't influence them as much as they used to. In the early stages, they were pretty much just another arm of government, whereas now they're much more independent. They were given sort of independent charters. They were given inflation targets. Like, the whole thing was trying to set up to say, let's try and set this thing up so that we never get this high inflation, and they had high unemployment at the same time. We never had that scenario happen again that we saw in the 70s and 80s. And I guess what I'm arguing is the pendulum actually swung too far.
Hmm.
We put in too many rules to ensure that there was no inflation, so that the rules actually ended up saying, we ended up with low inflation and disinflation throughout the period of the 90s and 2000s, where we actually needed people to get out and borrow lots of money in order to sort of bring forward demand, just to create the inflation to meet the targets that we'd set, because we'd sort of set the pendulum had swung too far, and we'd set the rules as to too strict about stopping inflation.
And that's sort of, I don't know sort of the right phrase for it, but sort of a Ponzi scheme, because you're pulling forward the demand by borrowing. You're pulling it into this period, or maybe a better way of putting it is like, Greece. They were just kicking the can down the road,
Exactly. You just keep
and here
saying
we
that,
are.
yeah, the way to get out of this is to get people to go and borrow. And pretty much that's what central banks showed over from the 80s, well, probably more the 90s through to today, is that they can either get people to borrow more money by lowering interest rates, and people rush out and get all these new loans and everything like that, or they can start raising interest rates and they manage to keep the level of debt roughly steady, or maybe fall a little bit. But they could never really get the consumers actually to deleverage back to more
Hmm.
reasonable levels. And
Hmm.
so, and that just meant that you just keep building up greater and greater debt burdens. Now, maybe they can keep doing that for longer. They probably can. Australia is starting to get pretty close to the end of that game. We've got way more consumer debt than most other countries. But the flip side is we've got heaps of government. Don't have very much government debt, and so we can probably gear up a
Okay.
lot on the government side. So yeah.
Um, Okay. Okay. So it sounds like the historical picture that you painted here is that we've been struggling for inflation for a really long time. But I know that within markets at the moment, the thing is, hooray, we finally seem to have inflation. And you've
Mm.
obviously done a huge piece of work that is in the process of being released at the moment about exactly this topic. So have
Yeah,
we actually seen? Are we actually seeing this inflation? I think you used the word entrenched before.
yeah, we're not seeing entrenched inflation. We are seeing inflation. Now the argument comes about whether it's entrenched or not. Now, there's been people for years and years and years saying that this is all going to end in tears. Inflation's going to get out of control. Everyone's going to be Zimbabwe. The central banks are printing too much money. There was a whole bunch of extremely eminent uh, economists. I think there might have even been some Nobel Prize winners and stuff in there as well, who penned an open letter to Ben Bernanke, back in 2009, saying, or 2010, saying, the things he's doing are terrible. They're going to cause runaway inflation, and it never did, and inflation never got above, sustainably above that 2%. It was actually, they
Right.
spent the 10 years fighting deflation, and so um, yeah, it is very much this part where um, we there is a lot of uncertainty about what the inflation is and whether it's sustainable. All those people tend to be out sort of screaming from the rooftops at the moment. Inflation's finally here. The US printed about an over 4% inflation read for the latest month, which sounds like, here we are, inflation's back and running.
So that's the highest number in what, like 15 years?
Um, there's probably
14?
been individual, yeah, I couldn't tell you exactly. There's
Okay.
probably been short-term
Oh, right.
blips
Okay.
of inflation, um, but certainly if it stays at that level, it'll be the highest level in a long time. The issue
Okay.
for me is there's two effects. One is there's a base effect. So basically, we had deflation last year because of the whole lockdown. So so this is talking about looking back over a longer period of time. And when you look back a year, you're starting from a very low base because prices fell and then they rose again. So if you measure back to say the start of the year, inflation looks much less, much more benign. The other thing is where the inflation is. So the inflation, 60 odd percent of it was in things like hotel rooms and and air tickets, which are actually still trading below where they were. So it's actually that the prices of air tickets and hotel rooms have fallen. Now they're starting to get back to normal, but they're still well below. Used cars was a huge amount. So I think that grew at 10% over the month. So uh, whereas new cars were sort of growing at 2%. So I think it's pretty obvious that you can't grow used cars at a much greater rate than new cars for any sustainable period of time. Otherwise, you're paying more for used than you are for new, and so some of the other categories was rental cars went ballistic. So all these categories, which to us are very transitory
They're not going to
measures.
keep going. Airfares aren't going to keep increasing by that much, nor are hotel rooms.
That's right.
Right.
Yes. And so at the moment, from everything we can see, that the types of the inflation we're seeing does marry up to being quite transitory inflation.
Transitory. Okay.
Yeah.
And so we're looking for entrenched because, as you said before, it's important as the oil or the lubricant for an economy, to kind of
Mm.
keep those wheels moving forwards smoothly.
Yes. And
And
that's
what
where
you're
we'll start
saying is
to.
that's not what we're finding.
Yeah. Now, central banks told us this was what was coming, and
Hmm.
we agreed with them. They said, we're going to see this inflation because of the base effects and because of these things bouncing out as we get
Yeah.
this extra demand. And there's
And they
also
continue to reiterate that, right? I think I saw a headline on
right.
Bloomberg this week that said another US central banker had said it's only transitory.
Yes, and so much of it as well seems to be supply chain issues. So it's a part
Mhm.
about going. There's a lot of a concern about semiconductors at the moment. We haven't got enough semiconductors. There's all these supply chain issues in terms of semiconductors. The semiconductors we're talking about tend to be the really cheap ones. So the expensive semiconductors are still being made because they have a limited amount they can build. There's all this extra demand. They're saying, okay, the $300 semiconductor we're still making because we make really good margins on that. But the one we could have built for $1, we're not making. So there's these things about the cars that aren't being produced because the electric seats don't work. So they built a $60,000 BMW, and they haven't been able to sell it because they can't. The electric seats don't work, and so then they're missing like
And you can't adjust it, right? There's no manual override.
yeah, and the parts are like a couple of dollars, and so but they just don't have the parts to be able to do it, and so for us, as we look through each of the categories we're seeing, it seems to be very much they're the types of things that are missing, and they're not the types of parts where um, you know, that the companies are saying, "Oh no, we'll never produce that part again," or we're not going to charge you $1 anymore for the semiconductor that moves your seat. Now we're going to have to charge you $50. They're just going, "Well, no, we're not going to make it for you. We have to build a new factory because we've got so much other demand." And when they build the new factory, yes, they'll do it at $1 or they'll do it at $5 or whatever. It's not a
Yeah.
meaningful amount when you look at the actual price of the car. And so, so it's more about a shortage that is in that supply chain, and that when that eases, you'll quite possibly see prices fall back.
Okay. So they're going to be addressed, right? Um, okay. So we talked before about why inflation is important to people, but it's important to investors as well, isn't it? Why is it important to investors?
Yeah, so you've got to think about it exactly the same way in terms of your wealth as your wages. Is that if you've got $100,000 or $500,000 or $1 million of investments, if that's just sitting still, then you're going backwards because you're put what you can buy with that money is going backwards every year because of the inflation.
Okay.
So you want to try and target to do at least inflation plus something, because usually you're taking some sort of risk. So in the bank at the moment, you're getting less than inflation. So it's what's called a negative real return. So you might be getting, even if you're getting 1% interest rate or 0.5% interest rate, that's below the inflation rate. So your purchasing power is going backwards by leaving your money
So
in the
that's
bank.
really, if we wanted to define a negative real rate of return for people, it's basically that the value of your dollars today is going to buy you less in the future as a result of that negative real return.
Yeah, that's right. And so on our tactical portfolios, and they're the investment portfolios where we buy both shares and bonds and cash. And that what we do, and it's quite common within, say, super funds to do this as well, is that we target a return of inflation plus some sort of number. And the number, it depends upon how much risk is in the portfolio. So the lowest risk portfolios, so the safest ones, we're sort of targeting inflation plus 2.5%. And some of the higher risk ones, it's more like inflation plus 4.5%. So the idea is that we want to maintain some sort of purchasing power over and above. So
You're going to grow it.
you want to grow it
You want to grow the purchasing power.
exactly in real terms.
Yeah. Okay. Excellent. So that's when you have inflation. So we don't have that much at the moment, but as you said, obviously the rates you can get at the bank are even lower. So you're going backwards in that sense. What though, as an investor, should people be doing with your view now that it's going to be transitory?
Yeah, so I'll tell you what we're doing is
Okay.
because it's a bit of a nuanced view, and it's a little bit based upon what market conditions are. And so what we've been doing is we've been saying for a while that the market's going to get scared with inflation, because when it's one thing for the market when inflation is 1% or below, and we're talking about future high inflation, they go, yeah, that's fine, that'll be later. When we actually do print the 4 and 5% inflation rates, the market gets scared and says this inflation is going to be last forever. And so we'd sort of positioned our
What is
portfolio.
it scared of though? I don't fully
It's
understand that.
it's scared of the central banks putting interest rates up to this, because interest rates are at rock bottom levels at the
Mhm.
moment. And what they're scared about is that the central banks will start to raise those interest rates. And then when that happens, some stocks will do well, and other stocks will do badly
Okay.
out of that.
It's and the raising interest rates is like a brake on the economy, right? And so they're
That's right.
maybe are they also scared that they might go too far or something like that?
Yep, absolutely. Yeah.
Okay.
And so what we so what we're looking at is that as interest rates, sorry, so we've taken the view that we want to try and we don't want to fall too far behind the market when the market gets scared about inflation. So we want to have a portfolio that's sort of set up to as if inflation is going to last for at least a little while. And when we haven't sort of gone overboard on that, but what we've tried to do is say, for example, in the banking sectors will benefit from that, and the energy sector and commodities will benefit from that. So we sort of went to either holding like an average amount of those stocks, or slightly above average.
Okay.
What we're starting to do now, though, is now that the market has got scared of this inflation, we're starting to wind those back. And the view is that we think we've still got another couple of months of the market being worried about inflation, but then the base effects will start to disappear. The supply chain will start to free up a bit more, and you'll start to see some of the more realistic views upon inflation. And so what we're doing is
Okay.
gradually shifting our portfolio away from one where we're trying to protect you against rising inflation to one where we think we can benefit from falling inflation expectations.
Okay. So, why sounds like we're trying to catch both sides there. Why is that?
Well, you could take a view now and say, okay, I'm going to assume that I'm 100% right, and that we will see deflation, and so position your portfolio completely for that. The issue is there is uncertainty, and we do think that the scare will
Okay.
last a bit longer, and things can change. So let's say, for example, Biden decided that he was going to greatly expand again the amount of money that he's pouring into the US economy, or we saw universal basic incomes throughout Europe, or other sort of more government support, which could actually lead to greater inflation. Then, if we'd taken exactly the opposite view, then we could get caught out and sit a long way behind the market. So what we're sort of trying to do is say, well, let's not be too far away, and then wait till we can see more of the effect we're looking for, and then take a stronger view once we're more certain of the outcomes. So I think that's
Okay.
with any investing. I think what we do is we try and have a position, and then you scale how far you go towards that view, depending upon how certain you are of the view. And as time goes on, we get more and more certain. Certainly, all the numbers we've seen so far are basically as we expected it, and markets have moved as if this inflation is real. And so, we'll gradually keep moving more and more as we keep seeing and say, yes, the inflation is looking transitory. We're not seeing, more checks mailed out from governments to consumers, those types of things flowing through.
Okay. Well, good luck. That sounds like I'm glad you're doing it, not me. That's a tough job.
Mm.
Um, Before we wind up, I actually have a question from a colleague who's interested in knowing what's the relationship between inflation in different countries. So you obviously mentioned Germany and Zimbabwe where they had their periods of hyperinflation, but that
Mm.
didn't go to the whole world. So is there a relation? What is it? Relationship?
Yeah, absolutely. So usually what you see is that currencies will change. So if you've got, say, no inflation in Japan, and you've got lots of inflation in Brazil, what you'll see is that the Brazilian real versus the Japanese yen will gradually fall to reflect that, there's the money's not worth the same. So
Okay.
you might start with one, one and one, they're both equal to each other, but one can buy you
Go
well,
on, you've
actually,
got to
let's
use it. The
put it another
Big
way.
Mac.
The Big Mac theory, yeah. So that's a common one out there. Is it's called purchasing power parity, and so basically means what can you actually buy in each country, and it's a tongue in cheek version, but it's actually quite a good scenario, which is saying, well, how much does a Big Mac cost in each country? And so it might cost you, need to get the numbers right, 500 yen to buy a Big Mac, and I'm not quite sure how many real, but let's say for argument's sake it was 500 as well. Um, is that in a year's time, it now costs you 600 in Brazil, but it still only costs you 500 in Japan, and so that means the value of the should go down by 20% of
Okay.
the Brazil, so that now you can still buy a Big Mac for the same amount of money. If you transfer your money into this other currency, you can still buy the same amount. Now,
Yeah.
in the long, oh, sorry, yep,
I was going to say, so the same amount of yen, if you convert it to real, will still buy you that Big Mac now or in 6 months' time.
exactly.
I think that's the idea.
Yeah, now that doesn't work in the short term. In the short term, there's definitely, you can go from buying two Big Macs in one country to one Big Mac in the other and things like that. But over the longer term, it does sort of come out. And the reason why the Big Mac is interesting is because it's got sort of um, a mixture of agricultural goods in there. It's got a fair bit of services in terms of, like making the bread and all that type of stuff. And then it's got wage costs of actually the person making the hamburger, and rent costs of actually having a restaurant. So it's sort of like that's why it's looked upon as not a bad sort of, you know, basket of goods, so to speak, in an economy. Mm.
Fascinating. Okay. Well, I'll be sure to let him know. Thanks, Damien. So on that note, I'll bring us to the end of the show. Um, So, though, before I say goodbye, if you have any feedback for me about this episode or any ideas for future podcast topics, please let me know in the YouTube comment section or send me an email at contact@nucleuswealth.com. And if you'd like to hear more from Nucleus Wealth, check out our other podcast, Nucleus Investment Insights, or head over to nucleuswealth.com/content. To stay up to date on news from Nucleus Wealth, follow us on social media or subscribe to our newsletters from our homepage. And also that article or those articles that I mentioned Damien has written about inflation, they'll be dropping on our articles page on our website too, so you can check that out. We'll put that in the show notes too. Thanks to my producer, Jaden Stent, sorry, Jaden, for his work today. And finally, if you know anyone who gets something out of today's episode, let them know about it and share with a friend to help our show grow. Thanks again for tuning in from myself and the team, and we look forward to catching you at the next one. Cheers.